Welcome to my channel CA Academy, and today we are going to deal with management override of controls, which comes under SIC 240. The auditor's responsibilities relating to fraud issued by ICAI is one area is treated as non-negotiable and high risk. Management override of controls is presumed to be a fraud risk in every audit. No exception, no escape. Let's understand it nicely. Why is management override so dangerous? Internal controls are designed by the management, but what if the same management passes manual journal entries, alters the estimates, approves unusual transactions, pressurizes the staff? Control collapses from the top. This is why SE 240 specifically mandates audit procedures. What is management override? It means management uses its authority to bypass or manipulate internal controls to commit fraud. Even a strong internal control system cannot prevent this fully. SE 240 mandatory audit procedures, auditor must perform these 3 steps. Test journal entries, because fraud is often executed through year-end entries, manual adjustments, entries passed by senior officials. What auditor should do? Unusual, check the unusual accounts, entries posted at the odd hours, round figure adjustments, entries without narration, and entries affecting revenue or expenses. Then second step the auditor should do, review accounting estimates for bias. Management can manipulate provisions for bad debts, warranty provisions, impairment, fair value measurements. Auditor must check consistency of assumptions, change in method without justification, pattern of optimistic, pessimistic estimates. Third, evaluate significant unusual transactions. Transactions outside normal course of business with related parties, near-end, year-end, complex in nature. Auditor must examine business rationale, supporting documentation, substance over form. Okay. Let's understand this with some cases. Case number 1, journal entry manipulation. ABC Limited profit was low. On 31st March, CFO passed this entry. Debtors account debit 5 crores to revenue account 5 crores. No invoice issued, no goods dispatched. Now the auditor will analyze revenue recognition risk, SE 240 presumption. Year-end manual entry, no supporting documentation, indicates management override. Auditor's action would be investigate supporting evidence, reverse entry if unjustified, consider material misstatement, modify opinion if not correct. Case 2, provision manipulation. Company normally creates 3% provision for doubtful debts. This year, it reduced to 0.5% without justification. Result, profit increased. Auditor's analysis will be change in accounting estimate, possible management bias, attempt to inflict profit. Required action by the auditor, evaluate basis of change. Okay. Compare historical recovery pattern. If unreasonable, treat as misstatement. Case 3, unusual year-end transaction. On 30th March, company sold goods worth 10 crores to a newly incorporated entity owned by CEO's relative. Payment not received till audit completion. Red flags. Related party, year-end sale, no commercial substance. Auditor must verify existence of buyer, confirm receivable, evaluate substance, consider fraud risk. This is very important. This type of cases comes in the examination. This present management override risk is present in every audit, cannot be eliminated, requires specific procedures. If fraud is identified, auditor must communicate to those charged with governance, evaluate impact in financial statements, consider reporting to authorities if required, modify audit opinion. Hope this is clear to you. Thank you.